Oil just exploded, and this is exactly the kind of market that can make traders a lot of money fast or absolutely destroy them, because in just hours, oil reportedly surged above $110, then above $112 a barrel. Inflation fears came roaring back, and suddenly, this is not just a geopolitical story anymore. It is a full market story. And in this video, we're breaking down the latest Iran war updates, what they could mean for oil, inflation, stocks, and volatility, and most importantly, how traders can actually approach this kind of chaotic, headline-driven market without getting wrecked, because most traders think the edge is reacting first. It's not. The edge is understanding what happens after the panic. So let's start with what just happened. The headlines making the rounds are intense. We've seen reports claiming Iran's Speaker of Parliament said that 7 million Iranians are ready to join the war against the US and Israel. Then oil reportedly surged more than 10%, then more than 13% on the day, pushing above $112 a barrel. Then came the inflation angle. If oil stays around these levels for another couple months, some models suggest US CPI could move toward roughly 3.6%, which would put inflation at its highest level since September 2023. And if that wasn't enough, there were also claims that traders had poured a record amount of money into a leveraged short oil ETF right before this move, meaning a lot of people were leaning the wrong way right before crude ripped higher. Then came another key update. Iran and Oman were reportedly drafting a protocol to monitor transit through the Strait of Hormuz, and that is where the market really starts paying attention. Because the Strait of Hormuz is not some minor detail in the background. That is one of the most important oil choke points in the world. So the second traders hear anything that even hints at tighter control, disruption risk, or supply uncertainty, the market starts repricing immediately. Not after confirmation. Immediately. That is why oil can go vertical so fast. That is why inflation expectations can suddenly jump. That is why stocks can wobble. That is why volatility can spike across the board. But here's where most traders get trapped. They see oil ripping and immediately think one of two things. Either I'm too late, or worse, I need to jump in right now before it goes even higher. And that is exactly how people get punished in a news-driven market. Because these are not clean, normal trend conditions. These are emotional conditions. They gap, squeeze, reverse, rip again, and punish late entries constantly. So if you're trying to trade this market, the first thing you need to understand is that this is not really about perfectly predicting every war headline. It is about understanding how markets price fear. When geopolitical risk jumps, money rotates fast. Oil and energy can catch a strong bid. Airlines and transport can come under pressure. Broad indexes can wobble because higher oil feeds inflation concerns. And once inflation concerns come back, traders start repricing the Fed path too. So now one geopolitical story is suddenly affecting crude, CPI expectations, bond yields, sectors indexes, and options pricing all at once. That is why this matters so much. This is not just international news. This is cross-market volatility. And if you trade options, this part matters even more. Because in a market like this, being right on direction is not enough. You can still lose money even if you guess the direction correctly. Why? Because implied volatility can get pumped hard. Premiums can get expensive fast. Moves can get stretched. And reversals can be violent. So if you chase too late, you can end up paying peak premium right before the move stalls or snaps back the other way. That is how traders get smoked. So how do you actually trade this kind of environment? First, stop trying to trade every candle. That mindset will kill you. In a market like this, you want to think in scenarios. Scenario 1, tensions continue escalating, oil stays elevated, inflation fears grow, and risk assets stay under pressure. In that environment, energy strength can continue, volatility can stay bid, and weak sectors can keep bleeding. Scenario 2, the market realizes the worst-case scenario is not happening immediately. Fear cools off, oil pulls back, and everything starts reversing sharply. That is when late chasers get trapped the hardest. Scenario 3. The headlines keep flipping back and forth. Panic, relief, up, down, up, down. And that creates one of the hardest environments to trade because both bulls and bears can get chopped up. And honestly, that third scenario is usually where retail traders lose the most, because they are not trading setups. They are reacting to emotion, and there is a big difference. A real trade setup has structure, a defined entry, a defined invalidation, a defined target, a defined reason to exist. An emotional trade is just, oil is flying, I need in right now. That is not a setup, that is FOMO, and the market destroys FOMO traders. So what do smart traders do here? They size down, they get more selective, they respect headline risk, they stop assuming every move is going to follow through cleanly, and they take profits faster. That part is huge, because in a headline-driven market, the biggest mistake traders make is overstaying good entries. They finally catch a solid move, then get greedy, then watch the reversal take back everything. In this kind of environment, clean base hits often beat home run swings. Another thing smart traders understand is that sometimes the first move is not the best move. Sometimes the better opportunity comes after the initial panic, after the crowd overreacts, after premiums get inflated, after positioning gets too one-sided. That is when patience starts paying. So yes, the Iran war updates matter. Yes, oil ripping above $110 and then above $112 matters. Yes, the Strait of Hormuz headlines matter. Yes, the inflation implications matter. But the edge is not becoming an emotional headline addict and smashing calls or puts every time a new post hits X. The edge is staying calm enough to turn chaos into structure. That is what separates traders who survive from traders who donate money to the market. And that is exactly why we built our free school community. If you want to learn how to trade this volatile, unpredictable, news-driven market with options, join our free community right now. Inside, you'll get one free trade setup every single day. Not vague market opinions, not random motivation. An actual free trade setup every single day so you can start seeing how we look at the market, how we structure trades, and how we manage risk in exactly this kind of environment. Then, once you start making money with the free trades, you can join our premium subscription to get all of our daily trades, or just keep making profits with the free trades. Either one is fine. The point is to help you start winning in a market that most people are way too emotional to handle properly. So if you're tired of guessing, tired of chasing, and tired of getting blindsided by volatile headlines, the link to our free community is in the description. And if you want more content like this, make sure you like and subscribe, because this market is moving fast. The headlines are getting crazier, and we're going to keep breaking down exactly what matters and how to trade it. I'll see you in the next one.